Okay, good morning, class. Today we are actually going to talk about international corporate governance. And when we talk of international corporate governance, the first thing that comes up is why are we talking about it? We all this while we've been talking about governance, corporate governance with respect to an economy, taking an organization and looking into the various stakeholders, both internal and external. But when an organization is operating, they at some point they are doing their business across nations. That's where the international codes of conduct comes into play. Different economies follow different rules and regulations. So what has to be done, right? And how it can be solved. So what happens is like when there, because of different nations following different rules and regulations, there is no uniformity, right? So then what happens, the leaders of different nations where trade is going on, they actually have an interaction to solve these issues, like how to bring about with something with uniform standards across nations which can be applicable, right, to solve all these issues. And that is what is known as that global governance or world governance. And as I said, it's becoming very important today because of the context of globalization. Now, the question that comes up is how basically we will be different nations having different rules and regulations. How can the entire world have same rules and regulations because different economic background, different social background, different political structure, different cultural background? How would that happen? So these are, we just talked about it, but you see these are the important, these are the growing powers today who are in the global governance who are operating. So, coming back to like how do we bring about uniformity in the rules and regulations that we can follow? Some of the basic principles, that is independence, transparency, accountability. Like this is basic thing. This can be followed in every nation. So when the leaders actually started interacting, they were concentrating on the core principles which would attract global investors to come and invest in your country, as well as like which would help you to go and invest in some other country. Okay, so there were some vital trends, some trends which were taking place, which resulted at the both at the corporate level as well as the investment level, which led to the development of the governance structure worldwide. So, what are these trends? First comes up is the triumph of corporation. Now, today, what has happened is corporation is the main factor for the development and of a nation and for improving the living standards because they are helping to generate revenue. They're giving people jobs. So corporation is playing a very big role worldwide. Second comes up is the global company. Today, as I said, big companies, they are no longer only confined to their own nation. They're looking outside nations, international markets, right, in various sectors. And that's where it comes when they're going into there, so they are helping they're helping in the trade, they are helping in generating revenue for the other nations also, where the foreign countries are imposing tariffs, sometimes quotas is there, but with giving people a chance to get employed in other nations. So that's where it's coming up. It's becoming a very important factor. Okay, so it's also giving rise to global investors. Now, when we talk of global investors, is today companies are not just concerned only with investors within the country. They want people outside, the foreign investors also to come and invest, right? And that's where when can you have foreign investors investing? When you have follow the international codes of governance. There has to be some standard benchmarks which needs to be followed throughout. Demand for capital, companies they need money, right? And so what happens, the investors would invest, but provided, as I said, the basic thing that comes up is transparency and accountability that has to be followed. So companies have to follow on transparency, accountability. They are actually focusing on this. So these are the factors which is playing a big role. Triumph of the code. Which code are we talking about? The Cadbury code, right? Cadbury code was implemented, right? It was implemented. Why? Which have actually encouraged the companies to disclose uh, how they were following the codes of compliance, and if they were not following, they had to give reasons which are they, or highlight the areas where they were not following the comply with they were not complying with the standards and why, right? So that made it when it because the Cadbury code listed out some best practices of governance, international governance standards, which every company have to follow, right? Universal codes, right? Some codes have been developed, universal governance standards or universal governance codes have been developed. Why? So that it becomes a guiding principle for all the companies to follow when they do business internationally or when they want foreign investors. An investor perspective. Right. So what happens up here is where we were talking the OECD code. We will all discuss this shortly. It talks also again of accountability and transparency. Right. So what is though it talks about it, but you know what, it does not have the power to implement the code. So what is, there is no requirement on individual companies to take notice or even disclose how much they have actually adopted it. So here what happens is, it's basically, though it doesn't, OECD doesn't say, but from the point of view of investors point of view, companies actually are following this. Why? Because otherwise they are thinking from the point of view of the investors. If they do not follow the comply with the international codes of corporate governance, OECD principles do not actually comply, say that you have to follow it. There's no such factor. Though it talks about accountability and transparency, but it does not say that you have to follow. Right? There's no power. It is not. It's a guideline. It's not a law. But businesses do follow it. They are thinking from the point of view of investors. And if they don't follow, then problems might come up. Investors may not want to invest. Okay, and so the latest development that came up was to ensure to implement the OECD principles was the formation of International Corporate Governance Network, or ICGN, which actually ensures that the OECD principles are being applied, and there is a body behind it which has the power to implement this change, right? Okay, so what happened also is because of the changing global scenario today, it has become necessary to bring in effective corporate governance practices in the corporate sector. That's important if you have to do your business, and if you want to have investors, if you want to be in the good books. So because mainly main thing is investors' confidence that is required. So what is needed is transparency and accountability today. And in this, like where we talk about it, so we have some of the acts which came up. As I said, first was the Cadbury Report in 1992, which was covering three basic areas. It was highlighting on the board of directors, the auditing, and the shareholders, right? So they focused their attention on the board of directors. Because board of directors is responsible for ensuring that the corporate governance mechanisms are put in place, right? And they should be responsible for the monitoring and assessment, right? And auditing plays a very important role, where it looks after whether where there is transparency in the company, so whether it's followed, and there has to be a healthy communication system with the shareholders and other stakeholders, right? So Cadbury committee was the one which recommended the need for these three committees in any company: audit committee, nomination committee, and remuneration committee. We had already discussed this earlier. Okay, the next report that came up was the Greenberry report in 1995, and the main areas it was highlighting again on accountability, responsibility. They spoke about full disclosure, alignment of director and shareholder interests, so the interests should match, right, and better company performance. Okay, so later on there were other companies, there are other committees which was formed as Hampel Committee, Turnbull Committee, Higgs Committee. So they established codes and guidelines for corporate governance in international platform. So later on they also came up and coming up with the new codes and improving upon the existing codes. So all these committees, they helped the codes that they put forward, they developed upon it. So it helped in establishing global governance practices. That's the most important thing, and to solve issues, international issues which is across boundaries, right? Okay, so it spoke about the how the governance should be done, the governance activity, both in developed as well as developing market, right? And which actually leads to the emergence of a global economy where you have the entire world as one single market, right? So the basic things, what happens is like the core main thing is independence, transparency, accountability. These are the three basic factors. Let's go to the next topic, that is international codes. Right. So international codes, how it's being done. See, we have the board of management, supervisory board, and annual shareholders meeting where they actually look into the codes. They come up with new. They have a discussion where they discuss about the problems. They come up with new codes or improvise upon it. They monitor, they advise. So that's how this is a structure. So what the universal codes is also called the codes of practices, which was first recommended by the Cadbury Committee and later on established by OECD and ICGN. What is the main purpose? To help governments to evaluate and improve their existing frameworks of corporate governance and also provide guidelines for all participants and regulators of financial market. Okay, so that's basically the most important. So codes of best practices, when we talk about it, so it says that all listed companies shall publish and circulate a statement along with their annual reports, okay, which talks about their compliance with the best codes of corporate governance. That talks about. And code of compliance is where we have all the listed companies should ensure that the statement of compliance with best practices is reviewed and certified by the statutory auditors, right? Where all these compliance will be actually verified before they are published by the listed companies. Okay, and where you also have who is also monitoring, we've also already discussed this, that it's the Securities and Exchange Commission who actually monitors this, and if they will be actually looking into it, that whether their companies are following by it or not. Okay, codes of ethics and conduct. These are all the universal codes that we're talking about. Companies should develop a code of ethics, a code of conduct, which will be applying across the entire organization. They have to develop that. It is expected that every single member of the organization has to follow that code of ethics, or there has to be a code of conduct which should be abided by all the members of the organization. It has to be there, right? And what happens is like if new staff joining, how would they know? There has to be trainings given to make the staff aware of the new codes, understand and how to apply them effectively. That should be there. Code of compliance with laws. Every company has to abide by the laws that is applicable in the economy where they are operating. Culture and ethical behavior, right? It's a company should actually have a corporate culture. Culture again means a corporate culture which every employee has to understand, and they have to be responsible for their appropriate behavior. Ethical behavior is appropriate, what is it, right? So they have, every employee should be aware of the corporate culture of that organization, and should put on, be responsible for their own behavior. They should put on the right kind of behavior. And who is responsible for this? To see that it's the board. Board has to inculcate, actively inculcate this ethical corporate culture. Okay. Code of integrity. Code of integrity. The board is actually responsible to ensure that ensure and also implement and maintain a culture of integrity. Integrity should be there, which should be the integrity should be actually percolating through all the layers in the organization, right down to the lower level employees, where the vision objectives should be very clearly mentioned. It should be sound, ethically sound. Okay. Code of bribery and corruption. That's another thing. Bribery and corruption, right? That is not good for governance. It hampers the long-term value. So board should come up with policies, procedures that if anyone goes for bribery or corruptive activities, they will be penalized, right? They will be penalized. Code of employee share dealing. Company should have clear rules saying regarding trading by directors and employees in the company's own securities, right? It should be ensured that individuals do not benefit from knowledge which is generally not available to public. Say you're working in a company, and you say Apple company, and you know the Apple share, they're launching with new shares, and so what you do before even the share it's launched, you start buying it. So what happens? The prices go up, demand. So that is what is known as insider trading. That should not happen. Code of whistleblowing. Whistleblowing is where it's a mechanism whereby any person, like it could be an employee, supplier, or any other stakeholder, they raise their concern when the company is not doing well, and they raise their concern and make it public without disclosing their identity, so that the proper actions can be taken, right? Okay. We come to the next topic, that is global corporate governance guidelines. Global corporate governance guideline principles and codes, right? It was developed as we discussed, in different countries, and they were issued from stock exchanges, corporations, institutional investors, association of directors, managers, with the support of government and the international organization. So it was developed, right? And so what happens, like compliance with these governance recommendations, it's not mandated by law, it's not mandatory. Although what happens, like the code linked to stock exchange requires, may have a coercive value. That may be forced on you, that you have to follow, which is linked with the stock exchange. But otherwise, it's not forced. Like it does not say it's mandatory, but it has been developed. Okay, so like say for instance, like different countries have different conditions to follow. So companies which are quoted on London, Toronto, and Australian Stock Exchange, they formally do not follow the recommendations of their respective codes, but they should disclose whether they follow the recommendations in those documents. Recommendations that's there, okay, and wherever they are not, they have to give explanation why they are doing so. So disclosure requirements is something which is very, very important today. This is important. This is the most important thing, and which actually puts a huge pressure on the companies. They have to comply with this disclosing what they are following, what they are not following. So see, it's a discussion happening. Where people across nations, they are sitting to discuss on the global corporate governance guidelines, right? So one of the most influential guidelines has been the OECD Principles of Corporate Governance, which was published in 1999 and revised in 2004, and then again we have the 2015 revision has come about. So this is often been referred by countries developing local codes or guidelines, right? So what are the global corporate governance on disclosure? What does it say? So this is an internationally agreed benchmark, consists of more than 50 distinct disclosure items across 5 broad categories. So these are the areas which needs to be disclosed. One is auditing disclosure. It could be internal, external, as well as to the government. Yes, quality-wise, board and management structure and process. How they are working, their performance, and whether when they make decisions, whether they are it's a unique consensus, corporate responsibility and compliance, information disclosure, especially with financial transparency, and ownership structure. And the exercise of control and protection of rights. Ownership structure, when we talk of shareholders, control and protection of rights of the shareholders. Okay, the next organization that we talk about is that came about was the ICGN. That was led by the investors, and it was set up by individuals who were involved with the 10 largest pension funds around the world in 1995. Purpose again is to promote global corporate governance standards. Okay. So, and then after that, there were many other organizations that came up also. WBSCD, APEC. They have also worked upon the corporate governance aspects, principles. Basically, again, talking of accounting, reporting, right? So, that's standards that needs to be there, right? Okay, then again, in 2009 we had International Finance Corporation, UN Global Compact. They also came up with a report on corporate governance. Again, talking of the same thing, how to go for a long-term sustainability by following transparency, accountability, financial disclosure, right? Now, most of these codes that we are talking of today, global corporate governance codes, they are voluntary. Like, it's not mandatory; it's voluntary, right? But what happens is today, these codes are companies are putting that in their they are actually abiding by these or these codes. They are actually putting it in their own codes of corporate governance within their uh, companies, within their organization. They are following it. Why? For the long-term sustainability, to gain investors' confidence, to be in the good books. So it's for their own benefits, that their own interest that they're doing it. Okay, so let's start with OECD. We will talk a little bit of it. Now, OECD was basically, it was formed, it was not called OECD, it was actually called OEEC, like, which was formed during World War II to restructure the economies. It's basically European countries, to restructure Europe, right? And later on, it was felt like if Europe has to develop, they have to also interact with non-European nations. So that's why the name OEEC. OEEC, that is Organization for European Economic Cooperation. So that changed, the name changed to OECD, Organization for Economic Cooperation and Development, right? Where the member nations are also European, both European as well as non-European, and it's both developing countries as well as industrialized developed nations. So to ensure that trade happens and the economies are developing and becoming more and more efficient, right? Okay, so the OECD Principles of Corporate Governance, as we've already discussed earlier, was published in 1999. But when it became so effective, when in 2000s, when we had the scams happening with Enron, WorldCom, that's when the need was felt that you need to actually abide by these codes, right? Okay. Uh, it's actually where when we talk of OECD today, what is it's basically focusing on it's today it's moving beyond the focus on its own countries and setting its analytical sights on those countries today, uh, which is nearly throughout the world, which will that will help in building up the market economy. It's not just concentrating on its member nations, but also non-member nations to develop that the market econ. There is an emergence of market economies. That's one. That's the basic thing today. So they are talking about like transition from a centrally planned to a capitalist system, where with regards to policy making and guiding. Okay. So when we talk of the policies, so they're talking of how various policy areas can interact with each other across countries, and why? Because different countries are having different types of policies. So how to interact, how to intermingle with them to come up with something which is internationally accepted. Okay. So purpose of OECD to achieve economic growth in the member nations, to contribute to economic expansion, and also to have expansion in world trade, right? So basic, if you talk of the basic objectives, it's talking about to have free flow of free international flow of issues, basically with regards to taxation and payments, services, governance, capital investment, human resources, scientific development, right? Um, okay, so it also concentrated in the development of industries and agriculture, usage of nuclear energy for useful purposes, and also highlighting on the environmental problems. So OECD gathers all information about these various economic indicators of the member nations, and then helps in sharing this information with the other nations. This is when we talk of the 2004 review, where what happened was the OECD members at that time, they wanted to establish standards with regards to create an environment where there would be fair competition taking place. So they highlighted on taxation area, right? That would how to develop the taxation aspect, which would encourage where countries would have their own freedom to apply their own tax laws without interference with the practices that would affect fairness and integrity of the tax system. So some flexibility without going into corruption, right? So OECD does not dictate any country to what it should be, but it gives a guideline, right? But OECD supports fair competition, right? Fair competition where when the tax imposition, that should be minimized. It should be flexible so that it benefits the nation as well as it benefits the investors. Okay, okay. So the reports that was there, it updates on the assessment on, as I said, the tax and basically they were talking about identifying the harmful tax which can be removed. So the report actually talks about towards global tax cooperation, right? So the report was issued by the OECD Global Forum. It spoke about transparency, exchange of information practices. So that's sure that why the exchange of information practices, so that other nations also get to know the experience that which you're facing, and they also learn. They can come up with something new. Okay, what are the OECD principles? Now, OECD principles, when we talk about they are voluntary in nature. Okay, they are evolution. They are voluntary because it doesn't. It's not forceful. They are guidelines, so it helps you to remain competitive in the world that is changing. It helps companies to go for innovation, come up with new corporate governance practices. Okay, which would help in creating new opportunities. But some of the benchmarks that needs to be followed is, as we said, is with regards to auditing, board and management structure and process, corporate governance, corporate responsibility and compliance, financial transparency and information disclosure, and ownership structure and exercise of control rights. Okay, so it the main purpose. So why was this? If it's not compulsory, if it's not it's not forced on you, it's voluntary, it's a guideline. So why was it developed? It was developed basically to help both the OECD as well as the non-OECD countries to evaluate and improve upon their existing legal, international, institutional, and regulatory framework. Okay, so and also to provide guidelines and suggestions to the stock exchanges, investors, corporations, and other parties who have a big role to play in developing good corporate governance, right? So OECD principles, it covers broadly the six. These are the 6 areas that we have, ensuring the basis for an effective corporate governance framework. The corporate governance framework should be very much effective, right? Present, the existing, current. The recognizing the rights of shareholders and their ownership functions, giving equitable treatment to all the shareholders, right? Stakeholders, the role of recognizing the importance and role of other stakeholders, following the concept of disclosure and transparency, and board responsibilities of the board. Board plays a very, very crucial role. They have very crucial role to play. So highlighting on that. Okay, so now the corporate governance framework, right, which should protect and facilitate and exercise the basic rights of shareholders, right? It should also include the right to secure methods of ownership registration. They should be able to transfer shares, obtain relevant and material information on a timely and regular basis. They should be able to participate and vote in shareholder meetings. They should be able to elect and remove members of the board. They should have a share in the profits of the corporation. That's one thing. We're going to details, and the company should also have an effective corporate governance framework. Why? They should have a corporate governance framework which would help in the economic performance, right? Economic performance, which would help to gain more incentives, market integrity, so promote transparency. That would come up. Shareholders should have the right to participate and be informed on any decisions regarding to any corporate governance changes, fundamental changes that's happening, right? The third thing that we come across is the capital structures and arrangements. It should be such which would help shareholders to obtain a certain degree of control based on their amount of shares that they're holding. Some ownership should be some control based on the degree of ownership. That should be there, and it should be all disclosed. Like all these, the ownership structure should be disclosed. Okay. All shareholders, whether they are minority, foreign, or major shareholders, should be treated equally. They should have all, because they are buying shares, everyone should have the same rights. As I already said, insider trading, we've discussed insider trading, and abusive self-dealing should be prohibited. Okay, the corporate governance framework should recognize the rights of all the stakeholders, which is there. Every stakeholder's rights should be recognized and should be given due respect, right? Okay, performance enhancing mechanism for employee participation should be permitted, right? There should be some mechanisms which would help encourage employees to participate, and which would help to enhance their performance. There should be timely disclosure, timely and accurate disclosure. Timely and accurate disclosure of all the materials regarding the organization, especially the financial situation, the objectives, performance, remuneration policy should be disclosed. That is important, right? The audit report that is conducted should be done by an independent, competent, and qualified auditor. We have already discussed this, that this is basically required because so that they can actually look into the financial statements from a neutral perspective, and the report that is published is authentic. The corporate governance structure should also ensure that the strategic guidelines of the company, the effective monitoring system of the management by the board, and the board's accountability to the company and its shareholders should be maintained. Okay, now OECD also have laid down some guidelines for the state-owned enterprises, right? So this OECD guidelines on state-owned enterprises or SOE, they basically give advice to countries how to manage more effectively the responsibilities as company owners. So it's actually helping these SOEs to become more competitive, effective, and transparent, and actually competing how to compete with the private organizations, how they should do it. So what is the purpose of actually developing the guidelines separately on the SOEs? To highlighting on the scale and scope of the state sector, impact of SOEs on economic performance, pressure for reform driving from globalization and liberalization, some governance challenges, benefits for improvement of SOE governance, and strong demand from non-OECD economies. That was also there. So, you know what? These guidelines are not, they are not binding. They are non-binding and non-prescriptive. Like if you want to follow, you follow. You don't. They are complementary to the OECD guidelines of CG. They do not alter any, preclude or alter any privatization policies, and they are based on a comparative report. Okay, so what they are actually talking about, they are talking about they are focusing on ensuring a level playing field with the private sector, that the SOEs and the private sectors should be at the same level. They should be competitive. The two sectors should be competitive. Why? Then what happens? Private sectors do not start taking undue advantage. So SOEs should be developed in a way so that they should be a competitor to the private sector, right? To reinforce the ownership function within the state administration, right? Highlighting on the ownership, the shareholders coming up. But again, because it's a SOE, so the state administration comes into play. Highlighting on the transparency of the objectives and performance of SOE, to strengthen and empower the boards of SOE, because government is involved, so for how to empower them, and to provide equitable treatment of the non-controlling or minority shareholders. So let's go into a little details on this. When we talk of ensuring a level playing field with the private sector, so what does it talk about? It talks about having a separate regulation and with the shareholders function, transparency of special obligations. There should be harmonization in all the legal forms, like the legal system that is there, SOEs in the state and the private, public sector and private sector, then the legal system should be the same, the laws applicable. There should be more flexibility in the capital structures in the SOEs, and competitive conditions. There should be where it should be the SOE should have an equal the degree, should be able to access to finance as easily as the private sector. Then only can they compete. The second one, as we reinforce ownership function within the state administration. So centralization or coordination of the ownership function. There should be coordination happening sometimes, or centralization of power. There should be a clear and clear ownership policy which should be disclosed. There should not be any direct interference in day-to-day activities by the government. Boards should be able to carry on their responsibilities. Accountability should be there, and there should be an effective exercise of ownership rights. Shareholders should have say there. Improve the transparency of SOEs, objectives, and performance, right? There should be a consistent and aggregate disclosure. So disclosure is must. Just because it's owned by state doesn't mean disclosure will not be there. Internal audit should be done. It should be given importance, and there has to be an independent external audit done, not succumbing to pressure of government. High quality standards for accounting and audit has to be there. Disclosure also should be there as listed companies. It should be disclosure. They should be disclosing as listed companies, private companies are doing so. SOE should also be doing. They should disclose on material information which is including all the financial assistance from states, transactions, and any related item, work, risk factors. Everything needs to be disclosed. Okay. The fourth thing that is strengthen and empower the boards of SOE. So there has to be a structured and a skill-based nomination process of the board members. There has to be a clear mandate with regards to the roles and responsibilities, and the board should have the full responsibility. They should be able to appoint the CEO. They should be able to exercise independent judgment, right? Which means there has to be a limitation in the number of state representatives on the board, and the separation of the position of CEO and chairman. The board performance needs to be evaluated on a systematic basis. How the individual members of the board is performing, how the board committees are performing, and the board as a whole is performing. Right. The fifth one is providing equitable treatment of non-controlling minority shareholders. Right. It is important for the state's capacity to attract outside funding. It is needed, like the state-owned enterprises, if they have to grow, they also need money. They also need funds from outside, and that is where you have to give equal treatment to foreign investors, the minority investors also. The impact on valuation on SOEs, the valuation of the shares of the SOEs and valuation of the company should be also there. It should be disclosed. It's needed for the general perception of the state as an owner, right? So why it's relevant for the general perception of the state as an owner, because state as an owner, so state should be, what does we say, the government is talking to private or enterprises to give equal treatment to all the shareholders. The government, the state-owned enterprise should also follow it. They should be the role model. They should also do it, and prevents the state pursuing objectives outside the SOE's interest. If you give very equal treatment to everyone, then what happens? It also prevents the state, the government, from actually coming. They try to achieve their own personal interests, right? Which may come into conflict with the SOE's interest. So it prevents. Next that we come into is we talk of ICGN, International Corporate Governance Network. So we go into details, right? As I said, it was set up by individuals who are connected with the 10 largest pension funds in the world, and it was established in 1995. The aim for setting it up was to promote global corporate governance standards, and money is involved because it's led. This organization is led by investors that manage today more than $18 trillion, and members are there today in more than 50 different nations. So it has developed global guidelines, which comprises of shareholders' rights, business ethics. Okay, so basic idea was initially it was discussed in the Council of International Investors. That's when it was discussed, and then it formally came up, right? So today it is a global membership organization. It started initiated in North America and Europe, but today it's become a global organization today, right? Okay, so it is basically highlighting, ICGN highlights today on three core activities. One is influencing policy. Influencing policy how? By providing a really reliable source of practical knowledge, practical experiences on the corporate governance issues, right? So what has happened, different countries are facing different sorts of problems with regards to corporate governance issues. So these are practical knowledge, and that has been shared. So it's reliable, that has been shared, and that helps in coming up with a better regulatory framework, right? Connecting peers. Connecting peers is it's connecting to all the members across nations, right? Through cross-border communication. It can happen through international conferences, through usage of other media where you have it's easy for you to connect. You can connect with people all across the world sitting at home. Today it's possible. Informing dialogue amongst the all the corporate governance professionals. How? Through publications of policies, principles, exchange of knowledge, and advancement of education worldwide. Like, that's how you talk, you exchange your ideas, and people get to know about it. Okay. Now, ICGN Statement of Corporate Governance Principles. So ICGN approach is basically, they have been working more on the OECD principles. OECD principles are not they are not their guidelines, but ICGN has ensured that the OECD principles are put into practice. So when we talk of ICGN approach, like it's a working kit statement of corporate governance criteria. It talks of corporate objective. The basic object, the main objective is to optimize over time the returns to its shareholders. That is the main thing. Shareholders' return should be optimized, right? So they have to think about the long term. The company has to think about how to sustain from the long term perspective, how to develop a good relationship with not just the shareholders but the other stakeholders also. Communications and reporting, disclosure, we're talking disclosure of accurate, adequate, and timely information, right? Voting rights of shareholders should be given. Shareholders should have the they have the free right to vote on issues, right, on various issues. Corporate boards, the board members, right, and board as a whole, as well as the members, they should be working and looking into or taking into consideration the shareholders' rights, shareholders' interest, and they are accountable to the shareholders, the board as a whole, right? And that's why each member on the board has to stand for election after 3 years. Okay, the corporation should disclose once upon the appointment to the board, right, who is being appointed, and also they should be disclosing it, right, about the identities, the competencies, the backgrounds, whether the board members are really independent, and the qualification, everything has to be there. The potential candidates, that has to be disclosed to the not just the board members but also the potential candidates who are facing election. That needs to be disclosed to the shareholders, and it should be disclosed in their annually. It should be disclosed. Okay, board should include a sufficient number of independent and non-executive members. That is required. Who has the right competency, right? And we have discussed earlier the responsibilities of non-executive directors. So it's required for the efficient to bring about efficiency, transparency, accountability, disclosure. So it's required, and also along with that, there are different committees which is there, which also is comprising of these independent non-executive directors, which helps in ensuring that the organization is on the right track. Corporate remuneration policies. It's basically, when we talk of the remuneration, we are talking of the directors or supervisory board members and key executives. Their remuneration should match, the structure should match with the interest of the shareholders, and that needs to be also disclosed, the board's policies on remuneration. Strategic focus. Okay, major changes, strategic modifications, changes that's coming up with the strategy with regards to business should not be made without prior approval of the shareholders. Shareholders need to give approval to it. Okay, they should be given sufficient information, and so that the shareholders can have a say on it. Operating performance, right? The corporate governance practices should focus board attention on optimizing over time the company's operating performance, how to improve upon the existing operating structure. Shareholder returns. Shareholder returns, when we talk of shareholder returns, it's talking again that companies should actually follow practices, and the board has to see that the shareholders' returns are optimized over time. Corporate citizenship, right? Citizens, when we say citizen of a country, when we say we are citizens of our own country, that means what? Our identity, we belong to that country. And how does it happen? How can we say to have that identity, to gain that citizenship, we need to follow the rules and the regulations of that country. So similarly, corporate citizenship, to if a company has to operate in a particular nation, they have to abide by all the laws that is applicable there. Then only then can they work. Okay. Corporate governance implementation, right? Wherever the codes of best corporate governance practices are applicable, they should be applied, and where they do not exist, investors and others should actually develop them. Okay, so we come to the next thing, that a comparative analysis of OECD and ICGN statement, right? Now, ICGN was founded in 1995, as it said, and its objective is to improve and facilitate international dialogue on various issues concerned. And through this process, the ICGN holds companies that the ICGN is holding, companies can compete more effectively and economies can best prosper. They can actually come out, improve upon their guidelines, and they can, which helps to achieve their objectives, and they are able to compete in a more effective manner. What about the OECD principles? Right, OECD principles, as we said, that came about in 1999, and which who was actually the main people who were responsible for this? It's the government of the G7 summit leaders who actually recognized, who felt the need for corporate governance. It should be an important pillar in the 21st century. They recognized it at that time. Okay, and that's how it was formed, right? So I see, when we look into the comparative analysis, ICGN is actually supporting the OECD principles, right, as a declaration of minimum acceptable standards for companies and investors around the world. ICGN says that OECD principles, these are the minimum acceptable standards that every company and investor should invest. Okay, so as what we say is, in other words, is ICGN has welcomed the OECD principles. They have it's needed it's needed across, but it can be applicable across interests which are diversifying in nature, diversifying practices and cultures. So different nations have different cultures, practices, interests, but still they can actually do it. So ICGN, along with the OECD principles, what they talk about is, they say that the governance, corporate governance, is now an essential factor that investors take into consideration when deciding how much to invest their money and where do they do it. So, which means that all the companies have to take into account the investors' perspective, and so they have to talk about, like, follow these principles, which would help to gain the confidence of the investors. Okay, ICGN, according to ICGN, they feel that the OECD principles, it talks about good corporate governance, but also, okay, ICGN goes a little further and says that there should be, because OECD principles are guidelines and it's not mandatory, so ICGN tries to ensure that the OECD principles are followed by making it mandatory. So it becomes by forcing, right? So there's some sort of force is there to ensure that OECD principles are best implemented. Right. So practical guidelines, what happens? It helps boards to meet the expectations or the worldwide expectations, so they can operate more efficiently, right? And they can compete for the money, global investment that is there, because there are competitors there. ICGN also says that if the investors and managers, they can succeed in establishing good productive communication, if they can have good communication system amongst each other, what will happen? That would help benefit the economy would prosper, business will expand, more employment, better wages, and also greater shareholder wealth. Everything comes up here. Okay, this is where it talks about. Okay, so that is why it's needed. Companies should follow OECD principles. That's what OECD, the ICGN has to say. So it gives guidelines, right? And also it helps to come up with a better, to develop the corporate governance structure, right? So it is what ICGN feels that it is in the company's best interest to follow these recommendations, right? Even though there is no like compulsory things that which is required, legal compulsion is not there, still for the best interest of the companies, they should actually follow it. So this is basically the table which talks about the difference between ICGN and OECD. That's what we had actually discussed right now. Okay, let's go to the different codes. We are going to talk about Cadbury Code and Sarbanes-Oxley Act. Cadbury Code was formed, it was formed on May 1991 by the Financial Reporting Council, the Stock Exchange, and the accounting professions. Why? Because there was a growing concern about the standards of financial reporting and accountability. There was concern coming about, and this committee was headed by Sir Tran Cadbury. That's why the name Cadbury Report. The final reports came out in December 1992. Okay, so it is talking about recommendations on how to improve raise the standards in corporate governance. So when the report came out, it talks about 3 basic recommendations. That the CEO and chairman's position should be separated. We already discussed this. That came from the Cadbury Code. Board should have at least 3 non-executive directors, or out of which 2 should not have any financial or personal ties with the executives. And each board should have an audit committee comprising of non-executive directors. Okay, so when we spoke, the Cadbury Code also actually is divided into that the entire report is divided into 3 parts that we have, right? Which are like how can, so that it can be applied, how can it be applicable throughout, to make it applicable worldwide and to ensure there's best practice. So they highlighted on 3 aspects. They divided their report into 3 aspects, which are main 3, that is about talking about leadership. Like every company should have an effective board. The board should be very effective and who would be collectively responsible for the success, long-term success of the company. Effectiveness. Okay, the board and its committee should have the right skills, experience, and independence and knowledge about the company, which whereby they would be able to discharge their duties and responsibilities quite effectively. And accountability. Board should be accountable, right? Accountable and for the company's performance, and they should be able to assess the company's positions and prospects in a proper way, and they are held responsible. Okay, along with this, there are other sections also which is there, which talks about remuneration package, right? So a significant portion of the executive director's remuneration should be structured in a way which is linked to their individual performance. So remuneration should be performance related. Relations with the shareholders. There should be a proper communication, and there has to be a mutual understanding with the shareholders, good and healthy relationship. Dialogues needs to happen at a regular basis, informing them, right? So these, along with these 2 are also there. So in total there were 5 areas where they highlighted on. Okay, next we come to Sarbanes-Oxley Act, which was came up in 2002, which was passed by the US Congress on 30th July 2002. Why? To protect investors from all the possibility of fraudulent activities which is done by the companies, right? It came up, because of all the fraudulent activities that was happening, scandals in Enron, Tyco, WorldCom, that actually shook the investors' confidence on the financial statement. So in response to all that, the Sarbanes-Oxley Act, or as we say SOX, SOX Act that came into forefront, and to ensure that the investors' confidence is restored. Okay, okay. So this is basically created. They create the SOX was created was formed to with special highlighting on creating new rules for accountants, auditors, corporate officers, and imposed very strict rules on how to keep records. Okay, so they highlighted on four areas. One is corporate responsibility and accountability for corporate officers, increase criminal punishment on law breaking, accounting regulations for accountants and auditors, and new protection on security laws and regulatory standards. Okay, now there have been the entire act again is divided into certain sections. Section 302 talks about having a mandate that requires senior management to actually verify, certify the accuracy of the financial statements. Now, what happens is any financial statements of a company before it's been published, now it's become mandatory. Someone from the senior management has to authenticate, the signature has to be there. So what happens if that statement is fraud, is manipulated, the senior officer is also responsible for it. They should have checked it. Section 404. Section 404, it talks that management and audit, it requires that management and auditors publish internal controls and reporting methods on the adequacy of these controls. How adequate are these, right? So the major things that comes up is public company accounting or accounting oversight board, right? This comprises of 9 sections and established that the private company accounting oversight board should provide independent oversight on public accounting firms providing audit services. Okay, and auditor, it also talks about auditor independence, where it says that it's talking about establishing standards for external audit, and they should be independent and to limit the conflicts of interest. So they're talking about the internal control mechanism, right? Where we are talking about the auditors audit, and both the internal audit should be the auditors should be independent. They should provide the independent reports, and it should be published, as well as on the other side where you're talking of the external auditor, they should be independent, right? And aware from all sorts of conflicts of interest that should be minimized. Third thing that they spoke about is the corporate responsibility, right? Corporate responsibility, where it says that all the senior executives should take individual responsibility for the accuracy and completeness of the financial reports. They have to take responsibility. The next thing they spoke about, the Act spoke about, is to enhance financial disclosures. It talks about how to have, talking about reporting requirements for financial transactions, which includes off-balance sheet transactions, pro forma figures, stock transactions of corporate officers. So everything needs to be disclosed. The conflicts of interest, right? There should be proper measures that should be designed, which helps to restore investors' confidence in the reporting of securities analyst. Commission resources and authority. So it talks about how to restore restore investors' confidence in securities analysts. This also talks about it, right? The studies and reports, it requires that the Comptroller General and the SEC to perform various studies and find their and support their findings. And next is the 8th one is corporate and criminal fraud accountability, where it talks about special penalties, criminal penalties that should be there for manipulation or destruction or alteration of financial reports, or other sorts of other interference if the people are interfering with the investigation that is happening, protection of whistleblowers. White collar crime penalty enhancement, right? This is basically talking about increasing the criminal penalties associated with white collar crimes and conspiracies. White collar jobs is it's the people who are sitting at the top level. If they are into crime, actions to be taken. Corporate tax returns. CEO should sign the company's tax return because CEO should be responsible. So what that means, making the CEO accountable for the fact that the company is filing the tax that's the right amount that is being filed, right? Corporate fraud accountability, right? Corporate frauds and records. Frauds should be given importance, and record tampering, right? These are should be considered as criminal offenses, right? And there should be special penalties for that. Okay, we go to the next topic that we have is fraud risk assessments. Fraud risk, now we're talking SOC, SOX, Cadbury code, everything was formed to prevent all these fraud things, right? So fraud is, today it's increasing, all these fraudulent activities are coming up. It's becoming more and more, let's say it's becoming more and more common today, right? So frauds can be of the three different types broadly. One is with misappropriation of the assets of the company. Corruption can happen, and also when you have fraudulent financial statements that's coming up. So you know what? To answer all these questions, there are 15 questions. These are 15 criteria which has been set down by the fraud examiner's manual. It's there in the fraud examiner's manual, which was published by the Association of Certified Fraud Examiners to prevent the companies to avoid the fraud and take necessary measures. So what are these 15 criteria? Do one or two key employees appear to dominate the company? Who is actually the key persons? Is it one or two persons, or is it everyone? One or two persons means, then what happens if things go wrong, you can actually see it. It's control, centralized. The control is centralized in the hands of few people, so they can be scrutinized. Their performance can be scrutinized. Do any key employees appear to have close association with vendors? Are they having it? If they have, means they will get, these vendors will only get the tender. In return, some benefits, some cuts will be given. So that can be actually reviewed. Do any key employees have outside business interests that might conflict with their job duties? Key employees check on their, do they have any outside their business which is conflicting with is having a conflict interest with with the business of the organization. So please look into it. So that means you cannot be engaged into any other activities where there is conflict of interest with your job. Does the organization conduct pre-employment background checks to identify previous dishonest or unethical behavior before employing someone? Please look into their previous job history, whether there were any dishonesty behavior or unethical behavior. Later on, you cannot say that, oh, we didn't know. It's a responsibility if you're hiring someone to check. Does the organization educate employees about the importance of ethics and fraudulent programs? This is very, very important. We discussed a little earlier. Company has to train their employees regarding the code of ethics, regarding anti-fraud programs. Then otherwise, you cannot blame the employees. You need to train them. You need to make them aware that this is what you can, what you cannot do, and what are the consequences. Does the organization provide an anonymous way to report suspected violations of the ethics and anti-fraud practices? So that is where you are encouraging whistleblower. Do you actually encourage whistleblower who would be able to report any suspected actions which are suspicious with regards to ethics or anti-fraud policies? Is the job or assignment rotation mandatory for employees who handle cash receipts and accounting duties? Like all those employees who are in the dealing with money, their job they should not be working in that position for permanently. There should be a job rotation. Why? Because to prevent any sort of accounting frauds, right? So that is why it's really important. Has the company established positive pay controls with its bank by supplying the bank with a daily list of checks issued and authorized for payment? At the end of every day, the company should have a check and balance, cross-check with the bank the total number of checks that is issued and authorized for payment. Does that match with the bank's accounts, bank's records, to see that to prevent any um, payment that is not been authorized. So if the checking happens, they can say, bank can say, oh, but there's another payment that has happened, and then it's easy for you to check that, oh, who did that. You can actually check who was the person who was involved in fraud activities. Are refunds, voids, and discounts evaluated on a routine basis to identify the patterns of activity amongst employees, departments, ships, or merchandise? They should routinely evaluate those transactions to actually look into for identify any actions that might signal fraud, right? So that has to be actually the refunds, voids, discounts. That needs to be also all the details need to be evaluated on a routine basis to actually see that it's done properly, so that no one is taking money, okay, without actually informing. Are purchasing and receiving functions separate from invoicing, processing, accounts payable, and general ledger functions? This is important. Segregation of duties is really, really important. And if you actually do not segregate these duties, like it can be actually lead to some manipulation, right? What can also, like what happens is the person who's actually looking after the purchasing and the receiving sections, and the person who is processing the accounts, if these are not segregated, then manipulation can happen. Certain things are processed but purchased, but then the invoice is not submitted. So the manager, if they want to do it, the personal items and supplies, they will not actually report it, right? So it can happen. Say, it can happen that sometimes technical supplies and home furnishings are purchased in the same order. You're just putting it, and you change the delivery address. Sometimes when you're ordering for personal items, you change the delivery address. So what happens? That nobody gets to know it's your own thing, and so you can avoid it, right? You're using it for your own business. Is the employee payroll list periodically reviewed for duplicate or social or missing social security numbers? Because some fake account can be created and someone is taking that money, the salary. So that needs to be checked. Are there policies and procedures addressing identification, classification, and handling of proprietary information? Right, to prevent all sorts of threat and misuse of intellectual property. So companies should have some policies and procedures which addresses the identification, classification, and handling of proprietary information. The people who are handling on those aspects has to have sign a bond. In some cases, have to give an undertaking that they cannot reveal to public. Do employees who have access to proprietary information sign non-disclosure agreements? This is where it comes up. They need to sign that agreement that they will not disclose this information. These are crucial information to any others, other rival companies, to anyone else. Failing which, there would be, these are trade secrets, right? They would be penalized. Okay. Is there a company policy that addresses the receipt of gifts, discounts, services offered by the supplier or customer? You should not take any sort of benefits from your stakeholders. Like that means what happens? You are falling under obligation to give them extra benefits. That should not happen. That is unethics, and it should be avoided. Are the company's financial goals and objectives realistic? That is also there. The financial goals and objectives of the company should be realistic. Then only can you have a proper financial reporting system. Otherwise, you can actually have proper control mechanism. Otherwise, it's very difficult. So, if you have only realistic financial goals and objectives, then only can you have proper justification in your financial statement. Otherwise, it's very difficult. Okay, we come to the last topic, that is e-fraud costs and risks. What is e-fraud? That is when fraud happens across internet. That is very common, right? It's done to make money to or obtain services using illegally or fraudulently acquired information. So it has a great impact on the internet economy, both in terms of money, right, as well as in terms of revenue that is lost due to decrease in confidence, people's confidence in e-commerce, and also the reputation of the brands gets affected. Okay, so what are the common types of e-frauds that we have? Social engineering. Social engineering is there whereby where social engineering comes from being how to become and you extract information from someone by trying to be very nice to them. You interact with someone nice, and then slowly what happens, become close to that person and take out personal information about that person without that person actually realizing that they're doing it. It happens with salesperson, salesperson who sometimes do it, who wants to you to actually subscribe for certain magazines, or they want to sell, so they interact with you and they become very friendly with you, and they actually manipulate you and they actually force you to do it. So you and start doing subscribing for it, or you start buying it, or you start revealing some your personal information. You say, I don't have money. Okay, it can be done. Why don't you give your account number? We can do it. We can make the payments online, and that's where you start revealing your information and you become victims. Okay, so this is a picture of social engineering. Next comes up is phishing. Phishing is also known as carding or brand spoofing. It's where you use emails in such a to extract information. These emails seems to be very official. Say your bank is sending an email saying that we are upgrading all the information. Please provide your account number, PIN code, and PIN number and everything. But please remember, banks do not, or your date of birth, social security number, banks and all these the other organizations, they will never ask for your personal information through email. They will tell you, come over to come to your respective branch or to office and with all the documents. So that's what phishing is. This is how it goes. Spear phishing. Spear phishing, it's a more complicated and effective attack on online identity theft. Okay, spear phishing is also called sniping, where what happens is the if the person who is actually the sniper, as we say, sniper is someone who is from back. So the person, the attacker, right, who's involved in the fraud activities, they can hack into your system computers, extract all the information without actually sitting with the computer. They can do it from their home. So that's what spear phishing is. So one has to be careful with whom you interact and whether you need to protect your information. So that was the picture of the spear phishing. Farming. Farming is somewhat of a typical of fishing. Now it's a more elaborate form of fishing, which involves more technical expertise to accomplish. So it's a part of a broad spectrum of fishing. It's a more elaborate form of fishing. This is how it goes. Advance fee fraud. Okay, so this is where this is also called the Nigerian scam or 419 scams. You will have a mail coming up where the fraudster says that I'm such and such person in such a country, we have some political disturbance, my life is in danger, can you help me to transfer the money to your account? I will be coming, and then I will give you a part of that money to you, and the rest I'll take. If you give me your account number, I'll send that money. Many people pray to it. Who's actually sending? Maybe someone in your locality who's sending that mail. If you give that account number, money will be transferred, but not to your account. It's from your account, it goes away. Okay, this is how it goes with the advance fee fraud case. Okay, identity theft. Identity theft refers to where unauthorized use of your falsely obtained personal information. Right? It could be your credit card. It could be your picture card, picture ID. It could be your registration domain. So people actually use your cards and your ID cards and they use it for their own benefits. It can happen. Okay, this is where it comes up. It's again the same thing. Credit card fraud, it's a special type of identity fraud where people, if it wrongly goes into the hands of the fraudster, right? So credit card information, they can actually use it. They can use it and they start using, misutilize it. They start purchasing goods, services, and you end up paying the fee. You have to pay for it. Okay, this is where it happens. So there are five ways to keep your business safe. Ensure checks and balances at the end of every day. Please check your business account, right? Total amount of payments made, total amount of money received. So have a detailed check. It needs to be done. Set up secondary payment approvals. Like when the payment is made, the checks approval, it should not be one person, but maybe two persons who has the secondary approval. Second person also has to sign on it, approve of it. So that helps, right? One person's signature can be copied, two persons cannot be, and people may not know it also. Usually people feel it's one person who signs. Improve upon your antivirus applications, upgrade upon it, right? So that people cannot hack. Antivirus prevents from all these the viruses that comes up, so it prevents, it protects your business passwords or user ID. So you update your antivirus application, that will protect you. Dedicate computers for online banking, right? Have separate computer only for online banking, not for your day-to-day work. That is one way of preventing. Open mail selectively. Think before you open. If you do not know the person, don't open it because it can have virus and it will just hack your computer, your data is lost. But no measure is 100% effective, and ultimately it's the common sense that comes into play. Your common sense, you have to use your common sense. If you feel something is very suspicious, think, give a second look, second thought before you actually work on that. Okay, that's all that we have in this unit, right? Okay, if you have any questions, we will have discussion in class, right? That's all for today.